Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's May the 12th, 2015. I wanted to provide a quick update. The first part of the update will just deal with the big picture and some of the numbers and what's been going on in the broader market. And then the second part of the update, just fill you in a little bit more about sort of our positioning and how we're taking advantage of what's going on in the market right now. So in terms of just market indexes and what's been going on in the market, let me just give you some numbers that hopefully will give you some context in terms of what's happening. First of all, if you look at the Dow Jones Industrial Average, so you're looking at the really large US-based companies, so far this year it's up about 1%, so it hasn't moved much at all. The S&P 500, which gives you a broader range of companies in the US, is up about 2% so far this year. Again, as I'm doing this video on May the 12th. Over the last year, these indexes are up around 10%. If you think of the Toronto market, the one where we have probably the largest exposure, that market is up about 4% year to date. But then if you go and look at the last 12 months, it's only up 5%. So most of the return over the last year has been during the first 5 months of this year. Now, the other area that we look at, and certainly our investors have watched these just very large swings, would be in the Canadian currency. You know, over a year ago, we would have been somewhere north of 90 cents, and then we would have collapsed all the way down to less than 80 cents versus the US dollar. Today, we're bouncing around 83 or so, so we're finding a little bit more stability in that 82 to 84 cent range, which, again, not giving you a prediction, but we would expect that that's probably sort of the longer term trajectory here, at least for the foreseeable future, in that mid-80s area. But much of that depends on global growth, commodities, what's happening in the oil sector. Speaking of the oil sector, as we've talked about before, we have had a relatively small exposure to the oil and gas sector, but the exposure we do have are in really some of the most profitable companies that can more than weather low oil prices. But this year we've seen oil actually on the uptick after falling by over 50% from around $100 a barrel to under $50. We've seen oil bounce back up to about $60 a barrel. So it appears for the time being anyway to have a little bit of stability there. But our position is, look, when we buy companies in the oil and gas sector, we buy really low-cost producers and companies that are vertically integrated and can make money not just getting oil out of the ground, but also refining it and distributing it through the retail operations. So companies like Suncor or Exxon, BP are some of the companies that we would own in our portfolios. The area that is particularly interesting right now would be yields. We're talking here about interest rates. And during the first 4 months of the year, 3.5 months into mid-April, we saw interest rates literally collapse all around the world. When I say collapse, I mean really go down, especially on government debt all around the world. We saw in many countries government debt trading at negative yields. In other words, if you bought a bond today, you were guaranteed to get back less if you held it to maturity. So you're getting a negative yield. In the last 3 weeks, we've seen interest rates really move up a substantial amount. Now, from an investor perspective, you might think, well, you know, that didn't go up much, but on a percentage change, the changes in yields have been really quite staggering. And so this is indicating that we might have seen the bottom in interest rates, and interest rates are starting to move up. And that's largely because they've been held down by central banks. And so we're watching that closely because, as you know, as interest rates come up, that will put pressure on the economy, less growth. It'll put pressure on the valuation of bonds. We want to make sure we're in high quality bonds, short-term bonds, and we want to make sure we're in lower priced, good value equities, because as interest rates go up, often that'll put pressure on the stock market. So we want to make sure that when it comes to bonds, when it comes to stocks, all of our investments are appropriately valued, because if the market were to be dragged down, we want to go down a lot less and use some of that cash we have on the sidelines to buy companies at much better prices. The European situation, just a quick note there, continues to be Europe. Most of the countries in Europe are broke, and so don't expect wonderful things to come out of Europe. Europe is seeing very little growth, and right now they're in the throes of the Greece situation, trying to extract money where there is no money. So we look at that, and it just means that we want to be careful. We try to avoid certain areas, and we want to make sure we're buying businesses that can weather, challenging conditions in Europe. Overall, when you look at global growth and look at GDP, which is your gross domestic product, it's an indicator of how much growth there is in the economy. As we've talked to our investors really right from the beginning of Rocklinc now for over 5 years, there isn't a lot of vibrant growth in the world economy. And that's because there's a lot of debt. That's because of aging demographics. That's because the governments are way, way too large, and so on and so forth. And so it's interesting to see that GDP so far this year around the world has been just really quite atrocious. It's been between 0 and 1% in Europe, in Japan, the United States. It's barely above 0. There's a chart that that's going up right now that you can look at, and you can see that despite all of the economists telling you how great things are in the United States, all of their forecasts have been virtually dead wrong, and the growth in the States is next to nothing. And so this year it's going to be pretty slow growth in the United States. Really, the only countries that are growing would be sort of India and China, and even those countries are under a certain amount of pressure. And so what this means is that when we're buying companies and investing, we've got to find businesses that can survive, can grow, are in unique niches that don't require robust global growth in order to be successful. And that's what we continue to look for. The next slide that I put up just indicates that many business people are quite skeptical of the overall opportunities in the market, because if you look at that slide closely, what this slide shows is the US GDP fixed investments quarter over quarter. That's how much businesses are investing in long-term capital. And if businesses aren't investing much in long-term capital, don't expect to see much growth in the future. And you can see that that number just went negative quarter over quarter recently. So that's a big concern. The last chart I'll show that again just emphasizes this fact that we need to hunker down and be careful on our investments, and that is that companies would rather spend their free cash flow, their excess cash, on share repurchases. In other words, just buying back their own stock, which under certain circumstances is fine, but if companies are more likely to just buy back their stock rather than invest in the future in capital, that again means that don't expect great growth in the future. It's not going to provide the kind of growth that we want. So these are all indicators of, listen, let's be careful. Let's keep our vigilance in terms of buying good companies and be positioned for market volatility. So we've listened to virtually all of our company's conference calls for the first quarter. Every quarter our companies report on their numbers. We've been very happy with virtually all of the companies that we own. Numbers are on track. We continue to buy companies with strong balance sheets, so they're in good positions. They're ready if interest rates come up a little bit. That's not going to throw off the different business models that we have exposure to. We're very short in terms of our bond exposure, so increasing interest rates really doesn't affect the valuation of our bonds in any sort of material way. And we continue to hold well-valued stocks. In other words, stocks that are not, ridiculously overvalued or trading on fumes, if you will, which is something you don't want to be owning in a market if that, that it might be weak, or if interest rates are rising, it could take the steam out of highly prized or highly valued stocks. So from our perspective, when we look at the market, this volatility is our friend. Volatility or choppiness in the market, up and down valuations in stocks, is a friend of those who are medium to longer term investors. We're hoping for more volatility, more opportunity to deploy cash that we've maintained in all of the accounts on the sidelines so that we can buy stocks even cheaper. So that's a quick update in terms of the current situation in the market. It's going to be, I think, an exciting back half of the year as we're now well into May. And from our perspective, we're being conservative, careful, and continuing to ferret out great companies trading at what we believe are strong and healthy valuations that should give us good future growth. If you have any questions, please don't hesitate to call, email, or stop by the office. Thank you very much. Bye now.